You know what typically happen after a doctor finishes training, they start becoming a consultant and then they start looking for jobs. How does one navigate around that stage of life?
Inside the normal lending space, that scenario is not looked upon favourably. But in the medical world, it is very, very different.
You got to find someone to advocate for you. Get a good accountant, get a good broker, and send it to the right bank.
Unfortunately, with regulators, there's not a lot of common sense lending anymore. And I think the medical industry, we're lucky there is some common sense where they can stretch policies and things, but there used to be a lot more common sense approach applied to credit, but the regulators are quite tough on certain rules and regulations now.
The major thing is to plan ahead. Hi everyone, welcome back to another episode of the Investing for Doctors podcast. Today we have Alyssa here with us. Hi Alyssa.
Hey B, how you going?
Good. So Alyssa is part of our lending team, and together with Eloise, you guys have now reviewed quite a number of doctors. And I think one of the few themes that often come up is what happens with serviceability surrounding major life events or changes in earning capacity. And in today's episode, we'll talk about a couple of those things.
Sounds good.
Excellent. Now, before we start, for those who have not met you, give us the quick spiel about who you are and what you do.
So my name's Alyssa Childs. I am a finance broker with Two Birds, One Loan. I have a long career spanning in financial services for over 20 years. But we started the business in 2018. Mm-hmm. We primarily do residential lending, but all kinds of lending really. We can do asset, self-managed super funds, complex structures and things like that. We've partnered with B and the IFD team sort of late last year. I would say it all sort of kicked off. Yeah. And very excited to be on board with you. We've been speaking to lots and lots of members of the group. So it's been really amazing.
Yeah. And sort of this episode came about after a conversation we had talking about, surrounding major life events, because as a doctor, there will be certain points in the career and your life where income's affected, or, you have to take time off, or where your income drops or becomes a different form. So to put it broadly, most doctors, they're either employed or there are sort of self-employed sole traders or a hybrid of those two. Is that sort of your experience so far?
Yeah, it has been actually. Yeah. So like you said, often hybrid. So they'll have the PAYG income and also be earning via education sources, self-employed company, ABN, and have a whole mixture of different income sources.
Yeah.
So so life events can definitely impact 1, 2, or 3 of these sources of income.
Absolutely. And I guess that's also where the challenge and of sort of advocating for the client and getting the best outcome for them, because their structures are so complex.
That's right.
Yeah. Absolutely. And so now we'll go through a couple of the major life events that one gets. And I think the way we can structure this is let's talk about the conversion from an employee to a hybrid or a sole trader sort of sources of income. And this, will typically happen, as you probably know already, after a doctor finishes training, they start becoming a consultant, and then they start looking for jobs in different structures. Mostly public stuff will be paid as an employee or as a VMO, which is a type of sole trader, or some of them will just go fully private. Yeah, so tell us, how does one navigate around that that stage of life, considering there is going to be sort of instability? Are there any sort of tips and tricks, or what are the things to look out for?
Yeah, we do see this, and we have seen this a lot. And we see that the income might go from, a reasonably average income, and it might just go on this balloon, super steep trajectory. And there are ways, and look, inside the normal lending space, that scenario is not looked upon favourably.
Yeah, which is a bit weird.
It is strange, but in the medical world, it is very, very different. So there are medico teams in a lot of the typically major banks, but some probably more second tier. But we often would go to major banks for this. They know what the income looks like for a doctor from that point in their career, and they will look at 3 months of ABN income and annualize that if they went to a standard sort of broker that hasn't worked with doctors so much in the past, they might not realize that these teams are even there.
Yeah.
Because they're more like a private lending team. They're like business bankers, specialist medico teams, and they can do weird and wonderful things with income. So don't be deterred if someone says to you, oh, you're newly self-employed. No, you need 1 year's tax return. You need 2 years tax returns or history on that income source before the banks will use it. That's not true.
And so that just basically means they either approach the bank directly or they've gone through a source that didn't bypass the initial screening.
In working with those teams. So I mean, some of the examples of the things that we've seen some of these banks do, we had one client who was PAYG, and he got fellowed and he was working via a GP clinic. So he was basically contracting to the clinic via a new ABN. He had 3 months operating on the ABN. So he was quite good with his financials. So he had, up-to-date interim P&L, and I would strongly recommend using an accountant or a bookkeeper to keep those figures current. And the lender essentially annualized that 3-month period. They shave off some percentages for expenses and things.
Yes.
Obviously, there's usually about 30% fees that are paid to the clinic.
30 to 40 depending on what sort of specialty.
But in terms of the comparison to what he was earning prior to starting on the ABN, it was a significant jump. He borrowed 95% for an investment purchase with no mortgage insurance on quite a competitive interest rate. So that type of deal would not be done any day of the week through the normal mainstream lending channels. That was through a specialist medico team with one of the majors.
Good. So it sounds like if you are just starting out on your sort of ABN, your sole trader path, then you definitely need to go through a broker unless you know some back channels to the particular or existing client of a bank that understands you well.
That's right.
And I guess this is the take home message for this is like, if you're newly minted, specialist or doctor and you're on ABN, going from a PAYG to an ABN, you got to get in. You got to find someone to advocate for you and sort of try and annualize that. Get a good accountant, get a good broker, and send it to the right bank as well.
Definitely. Yeah, it's so important. He'd actually been direct to the same bank I used.
Yeah. And what did they say?
No.
Yeah, they said no. Yeah. It's
just
quite funny,
going
isn't
to the correct areas. And he was so surprised. He sort of came and said, look, I think I have to wait 2 years. I've been told I can't get a loan because I've only had my ABN for such a short time. And he was shocked that he could actually get
and
the
that's
level
actually,
of lending.
And that's actually one of the very common feedbacks that we get is like, oh, I'm a newly minted specialist. I earn a lot, but no banks are willing to lend me. And it's just that they've just gone to the wrong places, I think.
That's right.
Yeah. All right. So I think that's pretty easy and straightforward. And that sort of shows from PAYG, it's very easy to, for banks to assess because that's something they do day in, day out. It's quite common.
Yes.
And what about in the situation we're starting to see a lot of sort of, mid-career, as in mid-career instead of mid-training doctors, taking gap years to do locuming. So then often they're a casual employee, or they are on their ABN, or they're a mixture of both. How does the bank view that and assess those situations?
Once again, are all case by case.
Yeah.
And banks do look more favorably on the medical industry with these types of situations. And once again, we would be working with the specialist medico teams because they're the ones that apply a bit more of a common sense approach as opposed to a blanket policy. So blanket policies is what we get through every other lender and even these major banks through the standard residential teams. But, once we can put together a bit of a picture, if they have 3 years history of earning $180,000 and now they're doing that via casual work or locum work or an ABN and that's consistent year on year, generally we can paint that picture and the bank can get comfortable with those figures. Those figures.
Yeah.
So it is all case by case. What they do want to see is stability. unless it's that situation where they have reached a certain point in their career where they know that that income is going to then follow a certain trajectory that might be higher than years before.
Yeah.
And different banks have different appetites too. So, you know, one lender in particular likes to see a bit of consistency from PAYG to self-employed. Another one might take, you know, there might have been 120 PAYG and they'll take 250 self-employed because the annualized figure might be 500.
Yeah.
So it really is case by case.
And and also bank by bank as well.
Bank by bank, and you just have to really put the story together and prove to the lender why that deal is a deal.
Yeah. So in a way, what what your role is at understanding what the client is doing, you know, the doctor is doing, and then packaging it up in a nice way.
Yeah, selling it to them essentially.
Bank, exactly. It's selling. It's basically selling the customer to the bank.
That's
in a way. Yeah, absolutely.
And look, typically, you know, these clients are strong clients, and the arrears, you know, book of these clients is very low.
Yeah.
So that's another factor too, is that they can take a bit more risk on doing things outside of the square because typically a doctor is not going to default.
Yeah, and I think we previously talked about in another episode, you know, unless you are dead, disabled, divorced, or deregistered, I think
you will pay.
You're gonna pay your interest, right?
Yeah.
Yeah. So okay, so those cases are quite sort of classic in sort of most doctors, and then so now we come to the next major life event that I'm sure a lot of listeners will experience or have experienced, and that is starting a family and having a child. I have gone through that process. I've got 2 kids of my own, and I think with the first one, it was still okay from a lending perspective, and then after we got to the second one, we really had to plan around that. So tell me, how does having a child or a dependent impact on serviceability and how much money you can borrow?
Well, of course, you have to add in a child, and that will automatically increase the minimum living expenses that we can use. But I think the primary thing to consider, even before you prepare to have a child, is what do you want to achieve? What lending do you want to get in the next few years? And what should you be doing now to bridge that period? So, and it is, once again, it's all case by case. It's all circumstantial. And if your intention is to go off work for 12 months, do you have enough funds to cover that period? Are you going to get the government pay for a period of time? Is there some equity in your property that you might want to release?
In preparation for
that's right. And look, a lot of doctors are extremely ambitious and don't want to take a lot of leave. So that's another factor. And that's just, we just have to work with every client that we speak to. If they are planning to have a child, what's your intention? And I think if it's your first child in particular, and I know because I went through this myself, I honestly was in a full-time corporate role at Macquarie at the time, and I thought, I'll have this baby and I'll just go back to my full-time corporate role.
Waltz right back in,
And I really didn't plan too much because I just thought, I'm just going to have the kid and I'll go back to work.
Yeah, I mean, over there you had maternity leave, right?
Yeah, so, we had maternity leave.
Yeah, and so you expected you did that and then or earlier
it would
or something.
I'd just go back.
Yeah.
And what I couldn't plan and prepare for was the emotional roller coaster that I went through after I had this baby. And I thought, and she was 10 months old and I had to go back to full-time work.
Yeah.
And I was very naive to think that it would just be back to the way it was, because there's full-time childcare and we had some family help. And, I then got pregnant again quite quickly and had another baby quite soon after that. And I just think if I had have been a bit more forward thinking in that, maybe it wasn't realistic for me to think I might go back into full-time work. We could have accessed some equity earlier on and,
released
I
it
think
so you just
look at all
comfortable
case scenarios that give yourself options.
Okay.
That if you do think you might go back straight away. You might not. So what's your plan B if that happens to you?
Okay, let's workshop this a little bit so we get some sort of concrete idea of, scenarios, for instance. I guess if someone was a, PAYG, a staff specialist that's employed in the public hospital, that's very easy because they get, most people will get maternity leave.
Yes.
And for that period of time, you'll be paid with a view that they will go back after a certain period of time.
Yeah.
So the way I see it, most people will take their either maternity leave at full pay or maternity leave at half pay with return to work date. How does the bank? I mean, obviously, if you can get all your landing stuff sorted before you are pregnant, great. But life happens.
Options.
Yeah. So there are options. And so what happens in the case, for instance, let's say the first example, they go on maternity leave and they'll use a mixture of annual leave and maternity leave to bridge that gap at a full-time rate.
Yeah.
How does the bank view that?
So what they're looking at is what you're returning to and what funds you have available to bridge that period until you return. So if you can get a letter from your employer, and this is for permanent, part-time and permanent roles only, that letter has to specifically say the date you're returning, the salary that you'll be earning, if it's pro rata to 3 days, what that looks like. And as long as you have money in the bank to bridge that period between now and when you return, they will actually use that return to work income to assess your servicing.
Okay. So you need to demonstrate funds that will cover that.
Yes.
And the letter stating that you'll go back.
So on the servicing calculator, essentially what they'll do, they'll put both the incomes in, they'll delete one, the person that's on maternity leave, and they'll get a shortfall of, it could be $5,000 a month.
So does the maternity leave pay actually factor into that calculator, or it doesn't?
It does.
It does.
Yeah. So the way they work out how much money you need to have in the bank to bridge it, if you have 10 months off and your shortfall on the calculator is $5,000 a month.
Oh, yeah. If
that's how much money you would need to have in the bank to bridge yourself. So that's another factor. If you haven't got any money in the bank, they won't take your return to work pay because they're obviously not going to give you a loan if you can't afford the repayments between now and when you go back to work.
And say if you had, say, 3 months of maternity leave and then 1 month of annual leave, right?
It's not so much factored in.
They're not going to factor that in.
Typically, they're all just looking at what's your salary that you're returning to, as opposed to you might be on your half pay now. But that will peter out within 3 months or 6 months. So essentially we're looking at the day you return, how much money's in the bank, what your salary will be, and can we bridge you for that period between settlement and when you go back to work. So if you then don't go back to work, there's nothing they can do if the situation changes, but they have to assess it's a trust that letter is legitimately going to take you back to work on that date.
So I'm going to be really specific. We have X period of maternity leave and we're going to go back full time at the end of that.
Yeah. Or part-time.
No, just let's workshop this for this situation. We're going to go back full time. We're adamant. We got, family to help. And say I'm doing 250 before. I've got my maternity leave fully covered and then I'll be back on the dot full time again. Does that have any impact, or would they still say we need to look at how much money you have in the bank?
It really comes down to the dates. So if you're going back, if you're only having 3 months off and you've got 3 months full pay and you're going back at that point, that's a situation we could say, hey, if there's no money in the bank, but this income's actually not going to change. But typically, the typical situation is like 6 months, 12 months.
Yeah, yeah.
And what they're looking at is what you're going back to. So they're very particular about what that letter explicitly does have to state.
Yeah.
So we usually would provide a template because you don't want to go to your employer,
Yeah,
especially
yeah.
if it's New South Wales
fill
Health.
it wrongly.
It
Yeah.
can be hard. We see it with teachers and health. Like, it's a big organisation that it's not so easy. But you can get it from your direct line as opposed to going to HR.
Yeah.
You can go to a manager to get that, but it does have to be very specific in what it has to say.
Specifically worded and then on their letterheads and all of that stuff.
And another factor there is that, a lot of doctors do a lot of overtime.
Yeah.
So what we're looking at though, because overtime can't be determined what you'll be doing when you go back. So they would actually be quite conservative there and look at your base income that you're going back to.
Yes. And not include all
as
the
opposed
overtime.
to forecast.
Yes.
Overtime.
Yes. Okay. So I guess obviously those will impact on your borrowing capacity, and if you can still maintain that during the period, then it's all good.
Yes.
No dramas.
That's right.
Yeah. And what happens if you're a sole trader in those situations?
This is a little bit of a grey area.
Grey. Yeah.
So, and it really is circumstantial. And once again, we really just have to dive into it with the borrower to say, what are your intentions when you have this baby? And what, I've spoken to quite a few people, and myself included. When I had my third baby, I was self-employed and I didn't actually stop working. And obviously, depending on your situation as a doctor, that might not be possible, but there's a lot of family support. We find a lot of doctors have a lot of family support. Some will get their parents to help from day one. Some doctors, females, will return to work within 3 months and the partner might take some time off.
Yeah.
So if that's the case, if the self-employed income is not going to be affected, it wouldn't really change the way we'd assess someone who's self-employed unless they said to us, I'm not going to be working for 12 months. That's a different story.
Yeah.
But if they say to us, I'm having the baby, and I spoke to someone a couple of weeks ago and they were about to have a baby, and the female, I think she was an obstetrician or something, and she said she was planning to just have 6 weeks, and then her partner, who was PAYG, was going to take paid parental leave.
Yeah.
It all depends on the situation.
Yeah, okay.
So we just have to ask a lot of questions and make sure that we've got them covered no matter what their plans and intentions are. And then once we know that, we then have to obviously get the bank on board. Yeah.
So I guess at the end of the day, it will be about what is the return to work plan and in what capacity the return to work plan is. For a PAYG person, it's easy to calculate based on their existing pay slips what the projections are. But if it was a self-employed sole trader,
it can be a little trickier for self-employed if they are planning to take time off.
Yeah, and if they plan to go back half-time, is it truly half of what they're earning, or is it a different ratio or something? But it's really about painting a picture, presenting it to the bank, and seeing whether they agree or whether they're comfortable with.
Yeah, and we try and apply a conservative approach to this sort of thing. So if their typical income was 500,000 and we were only needing to use 200 and they were planning to work through that first 12 months, we could probably get a story around that, around using a percentage of what they typically would earn as a full-time paid doctor.
Right.
But it's all case by case.
It's all case by case.
And it really is circumstantial.
Yeah, and that's where the expertise of the broker and working in conjunction with the accountants and the client will really help you determine what's the best outcome and how to present it to the bank.
That's right.
Also depending on how much they need to borrow, obviously.
That's right.
Yeah, because I remember my own case. We had a offer plan, one that was finished right in the midst of my wife's maternity leave that was unpaid. So it was a bit of a disaster, but we managed to get it through and it was fine. And I guess, you don't plan for these things, especially when things are being built and when things are finishing. So I guess, the major thing is to plan ahead.
Plan ahead if you can. And, sometimes you can't. Like you said, my second baby was a surprise
Surprise
baby.
one?
So
Yeah.
we had no intention of having a baby so soon,
Yeah.
but you just
Whoopsies.
manage with what the circumstances that you have. So yeah, if you can plan,
Yeah.
of course, if you have a property and you have equity and you really want to give yourself options, you can, before you plan for the child, you can go and get cash out and just have it sitting in your offset account for a rainy day. And ideally, that is something that you could consider, especially if one of you is planning to take time off and you're expecting a big drop to income, or you think your childcare expenses are going to be significant. But, you know, doctors have significant earning capacity too.
Yeah,
So once they go
yeah.
back, they tend to earn more than enough to cover all of these things. Yeah.
And one of the funny things is that these days we have a lot more flexibility in our when and where we earn money from. You know, with telehealth, with after hour stuff. There's a lot more avenue to generate money
That's
outside of
right.
the typical
For
office
multiple
hour.
sources.
Yeah.
We see quite a bit in education too, where they just
Yeah.
offer their time to train and do bits and pieces in education. So,
Yeah.
lots of different sources. But I think casual's the other grey area, and probably the more challenging area.
Yeah, the locums,
for maternity leave, is that if you're going back to a casual role, that's difficult. That is difficult to get that income factored into the equation.
Yeah, you know, personally, I have been a casual employee for the last, 4+ years.
Yeah.
And even though I'm casual, it just means I have a bit more flexibility in on which days I work. But overall, my annual income has been roughly the same throughout the years. So I guess if you show that regularity and consistency, then you could make an argument that that's the case.
Absolutely.
But if you didn't have any precedence, then they can be like, oh, are you actually going back?
That's right.
Yeah.
Yeah. But definitely consistency helps any scenario, but it is really not black and white when it comes to medical professionals.
Yeah.
There's a lot of grey, and there's a lot of room for massaging things through.
And the next question, which is related to having a child, is like, how soon when you fall pregnant that you have, like, do people declare that? And because, like, you know, often nobody declares to their workplace until well after the first trimester, or you know, within.
I mean, look, we like to think we're told in
Of
most circumstances,
course,
but I
of
do
course.
know that we're not always told. If it's really early on, you know, it's sort of, if they're still in the first trimester.
Yeah. Do you tell? Do you not tell? We don't know whether that's
in
going
that
ahead.
situation,
you know?
we're probably not told. But, you know, once you're sort of 6 months and it's imminent, we really have to look at what's the plan. Once we know, we really have to factor that into the equation and make sure that the borrower's covered. We don't want to put someone into a loan that they're then going to, you know, drop at income for 6 to 12 months. We do have to really plan for it once we know about it. But I'm sure that there are plenty of people in the first 3 months that don't feel the need to tell us at that point.
And I think that seems to be the common time point. You know, after
once
the
you're
first
past that
trimester,
safe sort of zone,
Yeah.
I think it's something you should be thinking of factoring into your assessment.
Yeah, absolutely. And the other part is that obviously the female doctors are, or there's, you know, spouses or male doctors are the one that have the child. But how does the bank view on, you know, fathers taking paternity leave, or you know, this sort of mixture of parental responsibility? Is it much the same, or it's just another person and not much happens there? Or?
And there are a lot of corporate companies now that are offering parental leave for dads. Lots. So
in New South Wales, we used to have 2 weeks, and you had to exactly tell them when you're taking it, and you're not allowed to change it if the baby comes early or comes late. But now it's a lot better.
It's better.
You get months now.
I think it is a topic that's been adopted widely across lots of different companies now.
So from a lending perspective, it doesn't really.
We look at it the same way.
There's no male female disparity in how that's being assessed.
Not. It really just comes down to what are you doing? How long are you taking off? How will your income be affected? Have you got money in the bank to cover it? It's the same thing, male, female.
Okay, all right.
Parental leave.
And obviously, once you have baby, then there's the question about, okay, who's going to look after the baby? Are you going to get parents? Are you going to get a nanny? Are you going to get childcare? And at what stage does that start? How do you project those things?
So what we essentially just say, because we're assessing you as though you've returned to work.
Yeah.
So we'd say, okay, you're returning to work full time. You're going to have a 1-year-old or a 6-month-old. What's your plan? If the plan is mum and dad are taking it, grandparents, fine. We don't have to factor in any charges. If it's a nanny, we just get an estimate. If it's childcare, we just get an estimate.
Yeah.
So it's all estimated really based on what they're telling us.
Yeah.
There's no way you can obviously put a figure on it. We're just forward planning based on what their intentions are.
Yeah. And you mentioned earlier that there's a sort of like a minimum expenditure for dependent. Does that factor childcare in, or is that independent of childcare, or just the living expenses?
Childcare in almost all lender servicing calculations is factored into your minimum living expense category. In the same category as groceries. It's a bit debatable. Like I feel like maybe it should
like
be something.
It should be independent because it's almost like private school in a way.
But to be honest, like we have to use a benchmark, and the benchmark is determined by your taxable income, your postcode, how many children you have, essentially. And almost all doctors we speak to, when I tell them this is the minimum benchmark we can use and this covers these categories, they say, I don't spend anywhere near that.
Yeah, so they spend a lot more? Oh, they spend less. Really less?
Typically, yeah.
Oh, geez, really?
Because a lot of them just work so many hours and lots of conversations where I say...
In terms of life expenditure.
Life expenses. Life. No, that excludes your mortgages. It excludes commitments, liabilities, car loans, credit cards. It's purely like your groceries, your recreation expenses, your public school fees, childcare. Lots of doctors, when I speak to them, are shocked at the amount we have to use because they say, I don't spend anywhere near that.
Yeah. Is that benchmark of their earning as well?
It is. Yeah.
So obviously it's household
taxable income. Yeah. Because typically your expenditure is a little bit relative to your income.
Yeah.
In most different careers, but in medical space, we find that doctors don't spend as much.
Well, maybe that's a problem that we're not spending enough of our earnings.
They're using their funds to build wealth and property portfolios and working such long hours in a lot of cases that, they're not out spending money on recreational activities and things like that. So it's just interesting.
Delayed gratification.
Thing that we've noticed. Yeah.
That's it. That's interesting. And so, as your lovely bundle of joy gets a bit older and older, there's we start talking about private school fees. So that is not actually included in that minimum calculator.
It's not.
Is it? Okay.
So that's one of a few categories that will be tacked on top of that minimum. So if your minimum household figure is 6,000 and you only spend 3, if you have $2,000 of private school fees, the bank will assess you as 8,000.
Yeah.
So you might only spend 5.
Yeah.
But they take the benchmark for the base categories and they'll tack on top private school fees, private health insurance, life and sickness trauma, nothing that's taken out of super. It's all the insurances that come out of your personal bank accounts. Strata used to be on top as well, but recently they've pulled that back in. So that now is in most cases categorized within that minimum HEM calculation strata. So that's a recent change. That used to be on top as well.
Right. Okay.
So but private school fees, and this can affect borrowing capacity a lot. I actually had one client yesterday and her private school fees are $2,000 a month and she's a single mum. Her ex-partner was covering half of them and he's decided he's not going to anymore. So they are an expense she's taken on.
Yeah.
But she has $150,000 in the bank. And she will that will cover her school fees to get both of those kids out of year 12.
Okay.
So in those cases, if there is savings, that we can exclude private school fees with some lenders. Some lenders will actually lend you equity. So they'll give you a $200,000 equity release to cover your school fees to get the kids out of school. And they will take those off your living expenses for your borrowing capacity calculation.
Oh, really? Okay.
Yeah. So
All right.
there is ways
So there's
around
ways
it.
to
There is,
counteract.
yes,
Okay.
yeah.
So I guess if you are very, very, your kids are very young and they're early in the private school path, it's probably not going to be worthwhile because that's going to be
It would be a
hundreds
lot
of
of money.
thousands.
Yeah.
Whereas if they are, in year 10, they've got 2 more years, and realistically, it's going to be, 80,000 for instance. I'm just making up numbers.
Yeah.
I'm sure some schools are more expensive than that.
The biggest one I've seen, I had a client who had 2 twin boys in Kings, and the fees were, I think it was like $50,000 a year or
100
something.
together. Yeah.
And he needed a certain amount to get them to the end of year 12. And one of our lenders loaned that amount, the full amount. It was like $330,000.
Yeah. And was that an equity release?
Yeah, as an equity release.
Yeah.
So he had a lot of equity, but they were struggling with cash flow because they were paying these school fees.
Yeah.
So the bank lent them the money to put aside to cover all the school fees until the kids finished school. Wow. And then they assessed their capacity excluding those school fees.
But that money was still sitting in a bank account somewhere.
That's right.
Yeah.
So the bank has given that to them.
Yeah.
And there's a bit of trust happening
There's a
there.
bit of trust there because technically you could say, well, I'm going to...
There is trust
and then you go and buy a Lambo.
But it's one of them. Yeah, that's right. There is. But, most people wouldn't do that because they'll end up defaulting.
That's right.
But, there is a bit of trust. But that's a real niche policy of one of the banks that we work with. That option is there because,
do many banks do that? Or is it only a handful?
No, we've got a couple that do that.
Okay.
It's not typical.
Yeah.
To lend money for it. Some will leave them off if, parents have written a stat dec that they're going to pay for them for the family, or if there is just cash in an offset account that's sitting there. Like my client yesterday's just got the cash there, and that's going to get them through to the end of year 12. But once again, there is options to workshop that. Yeah. So, if it's really significantly affecting capacity.
Yeah. I mean, 100,000 a year.
It's a lot.
Yeah. And that's, that could be $500,000 about borrowing capacity, wouldn't it?
It's huge. Yeah. Really, really big.
And so essentially what they've done is that they could pull some money out, set it aside there, and then obviously, in this situation, say if they pulled out $200,000, but then their borrowing capacity would have increased by $500,000. They're still net better off.
Yeah, that's right.
Yeah,
yes.
right.
Yeah. So the school fees, the private school fees make a big difference to capacity depending on how much they are. But some of these schools do have a significant payment required, and if you don't have cash and we're not getting cash out to pay for them, we have to put them on top of your expenses every month.
Okay. So essentially what you're telling me is that if the more kids I have and the more we put them in private school, the more screwed I am from a borrowing capacity. So you got to work harder and more, and
or have lots of equity and borrow it to cover it to continue to borrow.
or you can do equity releases if they let you do that.
That's right. Yeah. So it's a good policy to have up your sleeve for the people that, because they would have had to pull the kids out of school because they couldn't afford to keep paying
cash
those
flow
fees.
issues.
They would have had to change schools, which they didn't want to do.
Yeah. That sounds like a very interesting scenario.
Yeah.
Now we all had our family, and there's another sort of thing that does come up every now and then is when after many doctors qualify, as in, they've got their fellowships either as a surgeon or as a physician, and typically we'll see that some of these doctors would do a couple additional years of training, and we call them post-fellowship fellowships, or some of them will do PhDs. And in those situations, again, there is sometimes a earning drop when you go do either unpaid fellowship or a fellowship that pays you pretty much a minimum clinical wage. Mm-hmm. What happens then? I mean, there's really not much you can do around
No,
those,
not really. I mean, if the income drops, and we just have to look at it on, Yeah.
So try and get it done before that drops.
But then obviously if that's your intention, have you got a strategy to get through that period where you're going to have reduced income?
Yeah. So, I'm going to ask a question is that would certain banks say allow an equity release to fund a fellowship, or is that going to be difficult now?
It would be difficult if you say that that's what the funds are being used for, because the bank will know. If you say my income's going to be cut in half because I'm going back to studying, they wouldn't like that.
Yeah. But if I said I'm going to...
if you said I'm borrowing...
I'm doing equity release in
to buy a
preparation
boat,
to buy...
it's a different story.
Wait, so it's better for a boat then.
It's a different story. But the minute you say the income will be reduced, no,
banks freak out.
Yeah, they don't like that. So yes, no, you wouldn't be able to borrow to cover your repayments for a period of time. That's not a purpose that they would like.
But obviously, until that day, you can always plan ahead, make sure you have enough savings in your offset and all that sort of
you
thing.
can get cash out for personal use.
Yeah.
You can get cash out for a rainy day. So, there's no real restrictions. And a lot of the lenders are quite good with cash out these days. Like some of them will lend you $1 million and they don't really, other than you saying future investment, future personal use, they don't actually ask for any evidence, a lot of them. Not all of them. Some of them do want very itemized, detailed information about what that money is used for, even if it's 30,000. Some of them will give you $1 million with you just saying future investment. So again, it comes down to the lender, their appetite, their risk appetite, their policy. But again, it just comes down to workshopping it and planning forward to the future. Will there be any changes to your circumstances and how do we navigate that?
One thing that I faced personally was I had a PhD stipend when I took some time off to do a PhD. And so from a PhD, if you're doing a full-time PhD, your stipend is tax-free money. But one of the things I found really hard was that even though it was guaranteed for 3 years, they didn't look at that as income.
Oh,
yeah. So,
okay.
I mean, have you come across similar situations like that?
No.
Yeah.
It'd be interesting to put that, because it wouldn't be uncommon. It would be interesting. I don't know who you spoke to and what banks you were dealing with and whether that was a medical specialist team.
Well, I was a BOQ specialist back then. so they should know about this. But,
well, look, in that case, and I think it's just something you'd have to go to credit and just see if they're comfortable and how solid is that source for how long.
Well, it's funded by an NHMRC.
Yeah. So look, I mean, there's nothing we would just turn away and say, no, that's outside policy.
Yeah.
It would be worth chatting to credit teams around anything like that.
Maybe there are other lenders that would be flexible. Yeah. Okay. All right. And obviously back then I was also earning a locum income and a PhD stipend. But when you're on a good, I guess, a slightly higher bracket because of the locum income, that tax-free income is actually goes way further than you think it would.
Know.
It was only $40,000, but tax-free $40,000 is like
it's huge.
It's like gold. Yeah,
it is. Yeah,
but they didn't accept it, so I had to work.
Okay.
Doubly hard from the locum income.
Look, policies are changing all the time.
Yeah.
All the time. So, I would say if anyone's in that situation, just get it checked out. Not to say they will. And sometimes if there's a time limit on an income, they don't like that.
Yeah.
Like if someone's earning like a payment from an insurance policy and that will be finishing at 65. If the person's 40 or 45, they'll cut your loan term back so that by the time that income stream finishes, your loan term finishes. Oh,
that's a good point. So, if you're on an income protection.
Yeah, that sort of thing.
But they would take the income protection as income, wouldn't they?
Yeah, not everyone. And it does depend on the circumstances of the income protection payment, whether it's subject to ongoing reviews and things like that.
Yeah.
If it's just a guaranteed payment and someone's been classed as total permanent disability and they're going to get that payment till they're 65, that's generally no issue across the board.
And the bank would just give the loan until that age or
but if there's medical reviews, that sort of might determine you are able to go back to work and that might cut the payment out, and there's a bit more of a grey area, but we do have lenders who will do it in the non-conforming type space.
Yeah.
Yeah.
Well, what does that mean, the non-conforming?
Non-conforming, like non-banks.
Yeah.
So not your mainstream typical banks that you've heard of. I mean, you would have heard of them, but they're more like lenders.
Yeah, yeah. The
As
non-bank
opposed
lenders.
to non-banks.
Yeah.
Yeah.
And I guess when they land in those situations, the rates will be a bit higher.
Yes, that's right. Yeah. But they're good. They're there. They serve a purpose.
They serve a purpose. Yeah,
that's right.
Absolutely.
They're for the clients that don't fit the mainstream lenders. But so maybe in your situation, if that income only had a 3 or 5 year term, I can see how they might not be comfortable if they were heavily reliant on that. But maybe you could argue if I can only use 10%, or by the time you finish, you're going to go back to your normal wage. And it's all case by case.
Exactly. And that's what happened after I finished that. Then I spent more time on the locuming, and that was way more compared to what I was earning as a PhD student.
But look, I think that unfortunately with regulators, there's not a lot of common sense lending anymore. And I think the medical industry, we're lucky there is some common sense where they can stretch policies and things. But there used to be a lot more common sense approach applied to credit, but the regulators are quite tough on certain rules and regulations now that they can't, a lot of banks just cannot stretch outside of certain policies. But the non-banks are a little bit more flexible.
Yeah, because they have their own credit assessment criteria. And that's what they operate in. So they have to be a bit more flexible.
That's right. And that's their niche. Yeah.
Yeah, awesome. So I think to summarize, any major events that's happening, there's a lot of predictable ones such as pregnancy, further education, switching from a vocational training onto to becoming a specialist. There's all these particular time points in a doctor's career where they will transition from one role to another or have known changes in income. And I guess for every single one of them, just plan ahead. I think that's the take-home message.
As best as you can.
Yeah, as best as you can.
And just know that policies are not always black and white. So you might be told, oh, no, you can't do that.
Yeah.
Still investigate it.
Yeah, don't take it.
Don't take no for an answer. And I think your group is just an amazing forum to bounce things like this, because there are 27,000 people who more than likely someone has dealt with the situation you're in.
Exactly.
And that's what I love about it, is that you go in there and there's just posts every day of people just
there's so many exceptions here, exceptions there, and it's like, no, I've done this and I've tried this and this is the outcome, and everyone's like, oh wow, okay, nobody knew I could do that. Right. I'm learning from it all the time.
Everyone in that group will be learning from one another based on their lived experiences. I think just ask questions in there as a first port of call. And someone will probably know an answer or a contact or
and when in doubt, give you and the team a call and we can sort it out, hopefully. All right. Very lovely to have you on the show today. And hopefully we can guide a few, many more of our sort of colleagues down life's journey.
It's been amazing. Thanks, B.
Thank you, Alyssa. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.